Hello, everyone, and welcome to our podcast entitled On the Investment Radar. My name is Lorna Denny, and I'm joined today by Jaime Arguello, Chief Investment Officer of Architas. Jaime, to set the context for us, could you pinpoint the highlights of the first quarter in the financial markets?
Yes, of course, Lorna. During the first quarter, we had a continuation of a number of positive developments from end 2020, namely, first, the expectation of a continued cyclical recovery, helped, of course, by the very accommodative monetary policies, very strong fiscal stimulus. This, in particular, was even more material in this first quarter, with the 1.9 trillion US stimulus plan, which might be even completed by a 2.2 trillion infrastructure plan over 10 years. We had also the expectation of a strong cyclical recovery, generate naturally an expectation of increased inflation, which in turn led to higher long-term interest rates. This increase happened in a short period of time, which created some volatility early in the year, but rates have now stabilized, helped by very dovish comments from central banks. And finally, I will say in equity markets, we had a continuation of the sector rotation from the fourth quarter of last year.
Thank you. Coming back to this rotation theme, could you give a little more detail as to how this played out in the equity markets?
So during the peak of the COVID crisis, investors favored sectors that could benefit from the implications of lockdowns and restrictions and penalized those sectors that were most impacted by the recession. However, from early Q4 2020, with the vaccine developments, the expectations of a strong recovery after the 2020 recession started to be priced in markets, and therefore cyclical sectors like consumer staples, energy, and financial started to reverse early 2020 trends and outperform growth defensive sectors. In Q1, this trend has continued, and in this context, European stocks have performed very well as the composition is tilted to value and cyclical stocks.
Thank you for that. As a multi-manager, Architas can take advantage of investment themes as they evolve. Which are the themes that you feel will dominate for the rest of this year?
So we can indeed tilt our portfolios to specific long-term themes. This can be either the basis of the investment process of standard funds we invest in, or in some cases we can allocate to specific thematic funds. For example, we have a positive view on a number of long-term trends linked to energy transition to renewables, ESG, technology applied to consumer trends and healthcare, for example. Most of these themes had a very strong performance in 2020, so they naturally saw some correction in Q1. However, these are secular long-term trends, and we keep these themes in a number of our portfolios.
Longer-term trends, as you say. So overall, then, would you maintain a positive stance on riskier assets such as equities?
What I was saying in the context of a strong cyclical recovery and low interest rates, risk assets play a key role in a multi-asset portfolio. And it's likely that in 2021, they will be a core component of performance, and it has already been the case in Q1.
If we could turn to the bond markets now, there has been talk of a regime change since the beginning of 2021. Is that how you would describe it?
Yes, indeed. And this change in regime is totally natural as we move from a recession to a strong cyclical recovery and a pickup in inflation, which in any case is expected to be temporary. However, given the monetary policy stance, it is likely that this new regime or range will prevail for a few more quarters.
In conclusion, then, Jaime, would you describe the glass as currently half empty or half full?
I think it's always important to emphasize that investing is a long-term game. There will be always good years and bad years. 2020 was surprisingly quite strong given the circumstances. The factors that contributed to this outcome, monetary and fiscal stimulus, will continue to benefit financial assets for some time. In addition, vaccine rollout will facilitate, as expected, an easing of restrictions. As always, risks remain, in particular the speed of vaccine rollout or variants, policy errors, or geopolitics, and hence the need to stay invested in a diversified portfolio.
Sounds like another very interesting year ahead. Thank you very much, Jaime.
Thank you, Lorna.